Hi everybody, welcome to today's video and thanks for tuning in and joining me today. I'm so happy to be back making content for you. I know that the channel has just exploded underneath me. I'm so thrilled with everyone's interest in what I have to say about financial planning, retirement planning, estate planning. So thank you for all of your support. Today, being the first video back from taking a break in August, I thought I would do a recap in the markets, explain why the market is selling off, and what you can do about it. Let's try to do this in, say, 6 to 8 minutes. I'm going to zoom through it. I've heard you. One of the things you asked me was try to make the videos shorter, and so that's what I'm going to endeavor to do. Okay, so if you're new to this channel, my name is David Aaron. Welcome to my channel. I'm an active advisor working with clients right across Canada, business owners, individuals, and families. I help them with financial planning. Yes, I create the financial plan, I manage their money, and I do insurance as well. So I'm covering a lot of bases. I do full financial planning for my clients. If you're new to the channel, hit that subscribe button. You're gonna love the videos I've got because I explain everything sometimes in painfully great detail, but the topics are wide-ranging and easy to understand, so I hope you enjoy it. Put your comments below. I love hearing your feedback. But hey, let's get into why you're here today. So the first thing we're going to do is do a market recap. This is the markets as of Friday. Here we are in the Toronto stock market down 1%. The Dow Jones is down -4%. The S&P 500 down 4.5%. The NASDAQ down 6%, more sensitive to interest rate hikes. Even gold is down. And that is what is just the beginning of what's going to happen in September. And the question is, what is behind all this sell-off? Well, let's have a look. The month of September, the first thing, there are three things here, but the first thing is history. September tends to be the worst performing month of all the year of the stock market. In fact, since 1945, the S&P 500 has only gone up 44% of the time. The second part of why the market is selling off is we're nearing the third quarter, and companies are selling their investment firms are selling their worst performing securities to make their results look more favorable. And that kind of activity just drives the market crazy. It's wild volatility. The average investor doesn't understand what is driving this market. Is it really only a political geographical event? Is it weather? Is it interest rates? Like, what is it? This is one of the issues, right? It's artificially being created. It's not on purpose, but this is affecting the market in a big way. The biggest thing that's affecting the market right now is interest rates. So let's look at this. Canada is trying to get their interest rate up to about 3.5% by the end of the year. And to do that, they're going to have to raise interest rates. And they have 3 more opportunities to raise interest rates. The first one is this week, and we expect they're likely going to raise interest rates by 0.75%. The next one is in October and then in December. Similarly, in the United States, they're trying to get their interest rate up. And I would say, it says 3.5%, plan for 4%. The consensus is 3.7% right now. Everybody's guessing, but look at this. They have 3 more dates that they're going to be giving us news about what they're going to do with interest rates. And that's also happening in September, November, and December. So what is significant is 2 interest rate announcements in the month of September alone. That is going to be very disruptive to the markets, plus what fund companies are doing with securities, selling securities. So if you add those 2 big things along with everything else that we've been talking about all year round, about COVID and about supply chain and wars and all that, I mean, this is just another thing, pile it on top. This is another reason why markets are selling off. Okay, I also have a video here, so what can you do about it? Check out this video here. It's all about recession-proofing your investments. Now, it's a 30-minute video, and you've asked me to make shorter videos, but how do you teach somebody how to recession-proof their video or their portfolio in a 5-minute video? Like, it just doesn't do it justice. So that's one of the videos where I take my time to explain how to go through recession-proofing your portfolio. So take a moment to watch that video. Now, if you haven't done this already, you ought to reevaluate your risk tolerance. If you have a lot of anxiety around your portfolio and about the markets and what's going to happen the next 4 months, you really ought to be thinking about maybe having less equities in your portfolio. That means stocks, and more fixed income. That means bonds and GICs, that type of thing. to lower the risk in your portfolio, so you're not going to have these wild swings in the market. It won't be so dramatic to your portfolio. Now, the next group of people, the retirement zone. If you're nearing retirement, this is really talking to you. The 5 years before retirement, the first 5 years of retirement, I've said this in other videos, this is the critical timeline, 10 years, where you want to minimize the negative returns in your portfolio, severe negative returns. In this video right up here, I talk about the sequence of returns. I'll briefly explain to you, I'm not going to go into the full detail, but just notice this is a 10-year withdrawal timeline, and the bottom line talks about two successive negative returns when you're doing withdrawals. Okay, so you started off taking money out of your RSP, and that's a RIF, and you're doing your monthly, your annual withdrawals, and you have 2 years of negative returns. You can see what happens, the difference between the green line and that light blue line, which had positive returns, is a more than $100,000 difference after 10 years. Now, they didn't run out of money, but it's a difference of $100,000, and they're both taking out basically the same amount of money, and the average or the annualized rate of return is the same over 10 years, but those 2 years really is what caused the green line or the bottom portfolio to have less money after 10 years. Now, the other thing you could be doing is, if you're young and you're still investing right now, no problem. There's going to be great opportunities for you because the market is going to be dropping. But if you are nearing retirement or in retirement, you ought to be thinking about 3 to 6 months. How do I position my portfolio over the next 3 to 6 months? 3 months if you're like uber conservative. But if you're just uber conservative, I wouldn't worry about 3 months, 6 months. I'd just go conservative, right? Now, you just take your portfolio, go through that asset allocation, meaning what have you got in your portfolio for equities and fixed income in geography, Canada, US, or somewhere else in the world, and think about what kind of investments you have and how they're going to perform in an interest rate increase environment. With all the volatility we have, what would be a better type of asset for you to have in your portfolio? Look at these 5 categories: financials, consumer staples, energy, utilities, and real estate. Well, I hope you enjoyed this video today. I always talk about things that are going to be important to you, and I always say we take care of your wealth management so you can take care of what's most important to you. Thanks again for joining me in today's video. I look forward to seeing you in the next video. Take care.